European ministers postponing that final tranche by about a month. They want to see greater austerity coming out of Greece. But are they all singing from the same hymn sheet?
I think they've got little choice, Lerato. I think you can't let Greece go because you're letting the baby out of the bathwater.
Yeah.
The rest of them are entrapped in this whole process. The debt between banks and sovereigns, between each other and to each other, is so complex that they've got to try and trade themselves out of it. And we've heard lots of stories about kicking the can down the road and whatever, and it seems an extension of that.
I mean, with so many commercial banks in Europe exposed to Greek debt, the issue is who's prepared to fund Greece now? Because some sectors, for instance, or some countries are already saying Greece must not just show that it's got an austerity plan going on, it must also show that it can secure additional funding outside of this EU IMF bailout program. Who else is going to prepare to do this?
Well, I think that the funders, the creditor nations, are in a position where they have choice. The choices that they have are rather concerning, I think, anyway. So, would you rather go into a European situation or an American situation with the levels of debt that states, government, central governments, states, cities, utilities and whatever have? It's not an easy game out there. And yield will probably be where someone blinks and yields will firm, or yields will establish the trades. But I think that an important point there is that politics is an interesting game. You're only as good as the last vote. And what the real people that are paying and will pay for generations to come are the voters, and the voters' families, the little young voters to come. And they're getting really upset with the whole process. So, will the politicians who are sitting in court and in European Central Bank fora making these decisions, will they be there in 6 or 12 months' time or 24 months' time, is another very big question. So they can make a decision now, and yet the voters can have them out and ousted in no time flat.
When we're talking about yields, we've seen recently treasuries decline, so it's not just the situation in Greece. It's also no clarity as to whether America is going to abandon QE2, whether they're going to introduce a third phase. So with that happening, what are we likely to see in the bond markets, particularly for emerging markets?
Well, I guess starting at where the issues are in the developed markets is that yields will give to allow the funding nations, the guys that are actually prepared to or have the resources with which to buy bonds, to take that risk. So the market will find its own level. That's the truest of adages out there. Politicians can talk. The market will find its level. That's the game. As far as emerging markets are concerned, I think inflation is something which is on everyone's lips. Whether it's going to ramp up, I personally don't think that that's going to be the case. But when it does, markets will react and obviously rates will firm.
Institutional investors, particularly pension funds, how should they be playing this market at the moment? I mean, they've regained some value, but many of them have also been exposed to events overseas that we've seen. Many of them also apparently influencing the inflation situation that you're talking about by being exposed to agricultural stocks. Value in going into pensions?
Yeah, I think the question that we discuss in this context is probably the man in the street, the pensioner, who's part of a pension fund. He's in the hands of those trustees and the board that sit and the advisories that sit in making decisions around how funds are applied. To be in inflation-linked bonds, I think the market's close to value there. To be in equities, some would argue that global equities offer better value than local equities. We've had a hangover run. Are earnings going to disappoint? Well, our dividend yield is slightly off its long-term mean. Earnings are, I think there's a little bit of risk in sustainable earnings out of corporates, and if that's true, it means the market can react downward in price. But pensioners are not users so much of their capital as they are or should be users of the return on their capital. So the capital's deployed for the long term. The trustees and the investors, investment principles aren't going to change that game. But for the individual, I think they need to be well diversified.
For those who are looking at unit trusts, because of course we've seen the market a little volatile, a little bit declined, it's probably a good time to come in now, but is this just an aberration? This is not necessarily an indication of the market sort of in a steep descent.
Well, a lot of global and developed global market players are very, very concerned about the whole story, the whole global story. And yet earnings multiples are less demanding overseas in the developed markets than they are in developing markets, emerging markets. The story with unit trusts and investors is that if you invested in a fund which has a mandate that says buy shares, in other words, a long equity fund, an equity fund only, you really between a rock and a hard place. The manager has no flexibility to kind of take a view, even if he sees the train coming, is to run away and get into cash. His mandate is to be fully invested, perhaps defensively, but fully invested nevertheless. Whilst perhaps a person with a balanced mandate or a less aggressive mandate has the option of choosing a sort of a safer haven type of blend of assets.
Okay, just talking about the flexibility, why is it that managers are locked into equity funds at this particular point?
Well, if you had any of the major equity managers, they submit a mandate. Their fund there's almost by the mandate that they submit to the Financial Services Board in registering that fund, it would dictate what that fund is allowed and isn't allowed to do. So if it's an equity fund, it will be significantly exposed to equities. If it is a balanced fund, it would be allowed to, within a range, highs and lows, it would be allowed to go into cash, equity, bond and property and vary that quite materially over time.
So in terms of portfolio allocations, I think going forward, I mean, if resources are not, the market is relatively cheap for you to come into, given its declines, but should you be going into resources? Should you be going into cash? Let's also take into consideration the fact that we've got inflation that you mentioned and the interest rate cycle likely to change by the end of this year. So if you're Lerato and you're sitting there thinking, what do I do? What do I do?
Lerato, I think that the oldest story is getting a spread of assets, a spread of investments. The younger you are and the longer you're going to invest for, the more aggressive you can probably choose to be, because you're probably not betting the family fortune. You're betting a monthly contribution, a pension contribution, a retirement annuity contribution. If, however, you are a more mature, more established person, even one exiting the labour markets in retirement, you've got to be a whole lot more considerate of a number of things, like inflation. So you cannot really, I'm a great detractor from going into cash because you're now retired, because cash after tax is a not great return. Dividends, rentals, returns on investment, and a blend of those things is where it's at. The market has come off, it's come off a couple of percent. That's not the end of the world, because if one remembers just a few years ago, and we're all too good at forgetting a few years ago, the thing really melted down. And there were extraordinary opportunities and great value available in shares and through funds. Through the great the returns on equity unit trusts over the last 3 or 4 years have been pretty good, considering all the global meltdown just a few years ago.